Alright, so now for this next part, hobby loss rules. Basically, if you decide, oh, you know what, I want to be like a professional poker player or like a race car driver, something like that. If you start trying to do something fun and treat it like a business, but you're really just doing it for personal enjoyment, but you're not making a profit or anything, yeah. If you don't make money on stuff, you don't demonstrate that it's a profitable operation, or that the manner, like just depending on a number of factors. They have a list in your book at the beginning of the hobby loss rules section, and so they look at a combination of things. Like if you're really rich and you're able to carry on a non-profitable activity indefinitely like that, they're going to say no, that's a hobby. And basically what ends up happening is that you can't take any losses on hobbies, so no loss is deductible. And the expenses are very limited. They're limited to income. And yeah, it's very hard to benefit from them. So any income you make, you got to claim all of it, and then expenses, to the extent that you have a profit, you can itemize them. You can claim them as a miscellaneous itemized deduction, and that category is gone since the reform, so I'm not sure what we do with them now. I'll have to double check on that. But in general, just try not to have anything classified as a hobby. For education expenses, if you're self-employed, you can incur education expenses for things that help you maintain your skills, things like that, conferences, continuing education. But if you're an employee, you really can't benefit from it at all unless you're doing one of the credits we'll talk about, or the tuition and fees deduction. So you can do either one of those, or you can just try to get reimbursed by your employer, and that's the better part, not having to pay for it. Okay. Self-employment tax. So that's where you have to pay your share of employment taxes as well as the employer share. So remember, as an employee, rather than an employer, you have to pay roughly 7.65% in payroll taxes. Okay, so that's apart from your federal income tax. It's basically the Social Security and Medicare that comes out of your check. Well, your employer is putting in the same amount. They're taking 7.65% of your wages, and they're putting in their portion. So as a self-employed individual, you've got to put in like a little over 15%, like 15.3%, because you're covering both the employer's part and your part. Yeah, so that's a lot of fun. Anyway, I think that just about does it for the chapter. What I was going to do is, some folks were expressing an interest in me helping you out with some of these problems, as some of them are kind of tricky. So I think we worked through the first one in one of these videos. So I was going to go zoom over. I think somebody had a question on problem 8. This has to do with casualty loss. So now just beware that you might have different numbers than I do. So what I'm probably going to do is work with a problem that we can all get the same numbers to, and I'm going to do the one out of the book that coincides with your homework problem. So the number in the book, I think it's about number 53, and it's the one with Derek. So it should be Derek owns a farm, find that problem in your book. So it should be like around maybe 50-ish, 50. I'm showing number 53 in mine. And he's got 3 assets. He's got a building. He's got equipment. And he has a barn. And so one thing they're telling us is that the extensive damage throughout the area, the President of the United States declared it as an affected area by disaster. So if the President declares a disaster area, you have some flexibility on which you on when you can take a casualty loss. Now, I'm only going to go over this in the context of a business because the casualty loss for personal stuff has gone away with the new tax reform, unless the president declares a disaster area. But that doesn't happen very often. It's happened a few times in the last year, but it varies from site to site in the country. But let's talk about this one. So, let's see. It says the building and the equipment were completely destroyed. And how do I know that? Well, if you look at the fair value afterwards, yeah, it's worth nothing. So we're thinking, yep, complete destruction. And then the barn, we've got partial destruction. We can see, oh, okay, it's gone down. It's about the same, actually, it looks like. Yeah, it's the same before and after. Okay. Oh, no, it's not. The basis and the fair value before and after are the same. Okay. So, let's take a look. If the building is fully destroyed and the equipment is fully destroyed, we're going to take basis as our deduction. So I'm going to go ahead and plug in the adjusted basis of the building per the book. So remember, if you're working this out in Connect, you've got to use the numbers that Connect gives you. 68 on the equipment. Now with the barn being partially destroyed, we're going to take the lesser of the basis or the change in fair market value. So let's see. With the barn, fair market value before minus fair market value after. So before it was 145, after it was 95. So we've got a decrease of $50,000. And its basis is 95, so we're going to take the smaller of those and take 50. The smaller of the decrease in the fair market value or the basis. Okay, let's add up the total. So the total of all these, 118, 123, 203. So that's the gross loss, I guess you can call it. And then we have to reduce that by any insurance proceeds we got. So we got $55,000 in insurance from one. Looks like we got 105. So overall, we have a loss of $98,000 from this casualty. All right. I hope that one helps. Now, in general, with the disaster area thing, you can choose when you want to deduct it. So you could choose to deduct it in the year that it incurred, or you could carry some back to the previous year before the disaster occurred. So why would you do that? Why would you do that? Okay. The reason you might do that is so that you can get a refund from amending your prior year return, because you can write that loss up on the previous year return. You generate a refund immediately, so you'll get that check. Otherwise, what you would have to do is you have to wait till the next year to file the current year's return to wait for your refund. So that's why the government has that in there. They want to give you the ability to get your refund faster from any benefit you might get from these casualties. All right, what else do we got here? Okay, so in this one, it says that last year they had a taxable income of 45. So one way we could do it, we've got the entire loss. If we wanted to carry some of it back to last year, we could take 45,000 in the prior year, and then we could take the rest of it in the current year. So whatever 98 subtracted from, or subtract, and you subtract 45 from that, that would be, shoot, I can't do math. So 93, 53, I guess. Yeah, 53. All right, next. We're going to move on to problem 9. So that is number 54 in my book. It's got Rebecca in it. And I'm going to work with the figures out of the textbook. Hold on one second. Okay, so I'm showing Rebecca is a doctor with an AGI of 125,000. Before consideration of income or loss from her dog breeding business, her home is on 15 acres, 10 of which she uses to house animals and provide them with ample space to play and exercise. Her records show the following related income and expenses for the current year. So if her business is a hobby, what is basically going to happen is we're going to capture the income. So whatever money she grows from doing this business, and then we're going to go through and figure out expenses. We know that she's only going to be able to take her income to zero because she's not going to be allowed to do any losses on this. So we know that's how it ultimately falls out, but the way we would do it was we would take all of these expenses and we would add them up. So I guess 7,500. No, wait, I'm looking at the wrong thing. Oh no, these numbers are the same as your book. Oh no, wait, no, they're not. Yeah, they are. Okay, cool. Yeah, so the ones on the screen are the same as the ones in the book, so now we don't have to worry about going crazy. Some of the other ones are algorithmic. Okay, so let's look at this. We would add all these up, so we'd have 4,000 plus 3,500 plus 1,200, so that's 87. So I'm getting 9,050. So we have that number as her total expenses, and then we would take her AGI of 125,000. We'd multiply it by the floor of 2%. So remember, this category's gone away, so I can't remember exactly what happened to hobby loss stuff subsequent to 2017 when they had passed the reform. But this should be $5,000. So we would subtract the 2% floor. That would give her $4,000 and $4,050 more. But it would be limited to income, which is $2,500. All right, cool. Now in part 2, it says, well, what if it were held to be a business? Well, if it were a business, we would deduct whatever all day long. So we would have, in part B, our gross income of $2,500. We would subtract the total expenses. And then we'd end up with a loss of $6,550. And that would be that. Alright, now on this one, this is in the book. I want to see if they have the same figures. This is Landon. Yeah, Landon is self-employed. Yeah, and it looks like the numbers are the same. So he's got self-employment earnings of $195,000. And they want to know. Inquiring minds want to know. They just want to know. They want to know what his self-employment tax is and what his self-employment tax deduction is. So essentially, whatever we calculate for self-employment tax, he's going to get half of that as his self-employment tax deduction. Isn't that awesome? All right. So with $195,000 in income, let's do a new page here. We're going to multiply that by whatever the instructions on the form are. So 0.9235, and we get 180,083. And since our income is over the FICA limit, we're going to take 118,500, multiply it by our percent and the employer's percent combined, or 6.2% times 2, and that'll give us the Social Security, or also known as FICA. And we would also do 180,083 times 2.9%, or 1.45 each for the employer and the employee. portion. So that gives us 5,222. So our full self-employment taxes would go to 19,916. And then we could get the employer's portion by multiplying that by half. So this is the deduction in total for self-employment. And then you'd normally be bar hopping and all that stuff, so that would be an insult. I don't know, but we would take half of that. And 9958. Okay, so I think that's enough on this one. I'm going to stop it and then I'll restart it to do the last homework problem, which has a bunch of stuff in it.